Nvidia is the most valuable company ever, and it's priced to peak. Why? So here's the puzzle. Nvidia is the most valuable company in the history of the world, about $5 trillion. It has roughly 70% of the entire AI chip market, and operating margins near 65%. By every measure, it is the single best business of the AI age, and yet, it trades at only about 32 times earnings, an ordinary market multiple. That's cheaper than Palantir, cheaper than half of software. The most important company of the entire AI boom is priced as if its growth is about to stop. Why would anyone bet against Nvidia? The answer isn't in Nvidia's numbers, it's hiding in its own customer list. First, be clear that the discount is real, not an illusion. A company growing this fast with margins this fat would normally command a rich premium. Think 50, 60, 100 times earnings, the way the market pays up for Palantir. Nvidia gets about 32. Put its growth next to that multiple, and the math says something specific. The market is not paying for the future, it's pricing a peak. It's betting that a year or two from now, the explosive growth cools. So this isn't the story of an overhyped stock, it's the opposite. The most dominant company in technology, priced with open suspicion. The only question that matters is why the market doubts a near monopoly. Reason 2, and this is the whole anomaly. A handful of giants, Amazon, Google, Microsoft, Meta, make up a huge slice of Nvidia's data center revenue. They are its best customers, and every single one of them is now building its own AI chips. Google has its TPUs, Amazon its Trainium, Microsoft its Maya, Meta its MTIA. This isn't a science project. Custom chip shipments are growing around 45% a year, while ordinary GPU shipments grow about 16%. Amazon alone has committed something like $200 billion to its own silicon. So look at the tension the market sees. The customers big enough to be Nvidia's entire business are the only ones big enough and rich enough to replace it. Its best customers are quietly becoming its competitors. Reason 3. Here's why 70% share still holds. Nvidia's moat was never really the chip. It's CUDA, the software layer that every AI developer on Earth is trained on. It's the networking. Nvidia sells the whole rack, the chips plus the plumbing that lashes tens of thousands of them together, not just a lone processor. And it's a product cadence, a new generation roughly every year that no one else can match. A custom chip is tuned for one company's one workload. Nvidia sells the general purpose platform to everyone. And ripping it out means retraining your engineers and rewriting your software. That switching cost is slow and expensive to pay. That's the real reason the giants keep buying even as they build. Now the honest other side. The bull case is simple and strong. The pie is growing faster than the customers can defect. AI compute demand is exploding, and even a shrinking slice of an exploding market can keep Nvidia growing for years. The custom chips mostly handle each giant's own internal workloads. The open merchant market, everyone else who needs to buy compute, is still Nvidia's, and it's still expanding fast. So the falsifier is precise. Watch whether Nvidia's data center revenue keeps climbing, even as custom silicon's share of the market rises. If total demand outruns the defection, then a 32 multiple on a company still growing is not a warning, it's a gift. The bear needs the market to shrink or stall. The bull just needs it to keep exploding. So step back. The market isn't doubting Nvidia's dominance today. Its share and its margins prove that dominance is intact. What the 32 multiple is really pricing is the day, somewhere out in the future, when its customers no longer need it as much. The low multiple isn't a verdict on the moat, it's a verdict on the clock. The tell was never the record revenue this quarter. It's who is designing the chips for the generation after next. And this is the tell for any supplier whose few giant customers can build what it sells. The moat can be genuinely wide, and the multiples still stay low, because the customer is also the competitor. A concentration risk doesn't show up in this year's earnings. It shows up in the price you're allowed to charge for them. So back to the puzzle. Why is the most valuable company ever priced like it might peak? Not because the moat is cracking. It isn't. Not yet. It's because the very customers who made Nvidia the most valuable company on Earth are the ones with the motive and the money to erode it, slowly, from the inside. The discount is the market pricing a concentration risk that is real, but gradual. Apple once did this to Intel. Intel's marquee customer quietly designed its own chips and walked away, and the world's dominant chipmaker never recovered its throne. Nvidia's moat is far deeper than Intel's ever was. But the verdict on the multiple is clear. The moat is intact. The low price is a countdown on customer concentration. And the tell is the customer roadmaps, not this quarter's record.